ETF or stocks, which investment can help you build wealth more effectively? If you're new to investing, you've probably wondered which option is better. For educational and informational purposes only. The content shared should not be considered or legal advice. Stock market and ETF investments are subject to market. Please do your own research or consult a financial advisor. Some investors prefer stocks because of their high return potential. Others prefer ETFs because they offer diversification and lower risk. Today, we'll compare both options and help you decide which one suits you best. Before we compare ETFs and stocks, let's understand what shares and stocks actually mean. A share represents a single unit of ownership in a company. For example, if a company has 1 million shares and you own 1,000 shares, you own a small portion of that company. As the company grows, the value of your shares may increase. You may also receive dividends when the company shares its profits with shareholders. Now let's understand what a stock is. The term stock is a broader word used to describe ownership in one or more companies. In simple terms, a share is a specific unit of ownership, while stock, for example, you can say you own stocks in different companies, but you own shares of a particular company. In everyday investing, people often use the terms shares and stocks interchangeably. Now that we understand shares and stocks, let's move on to equity shares. When you buy an equity share, you will often use the part owner of a company. The company's success and growth can directly impact your investment returns. When you buy an equity forms well, your share price may rise over time. However, if the company struggles, investment value may fall. When you buy an equity of the company can directly impact your investment returns. If the company grows its profits, its share price may increase over time. When you buy by understanding can directly equity shares are. When you buy a stock, you become a small owner of a company. When you buy by a holder, you may also receive dividends from company profits. Many successful investors have created wealth through long-term stock ownership. When you buy by a holder, however, not every stock becomes a winner. Many succeeding the wrong company can result in significant losses. When you buy by stock, investing requires research and patience. Now let's understand what an ETF is. ETF stands for Exchange Traded Fund. An ETF combines multiple stocks into a single investment. Instead of buying many companies separately, you can buy one ETF. An ETF combines multiple stocks into gives you diversification. Diversification means spreading your money across many companies. This helps companies reduce the impact of one company's poor performance. For example, a Nifty 50 ETF invests in many of India's largest companies. If one company struggles, the others can help balance the portfolio. For example, a Nifty 50 ETF invests in many of India's largest companies. If one company struggles, the others can help balance the portfolio. Index ETFs track a market index, such as the Nifty 50 or Sensex. They aim to deliver returns similar to the overall market. Index ETFs are popular because of their simplicity and low cost. They aim to deliver. Another type is a sector ETF. Index ETFs focus on a specific industry, such as banking, technology, or healthcare. If the sector performs well, investors may benefit from higher returns. However, sector ETFs can be riskier because they depend on a single industry. If the next are gold ETFs, investors may benefit from higher returns. Gold ETFs allow investors to gain exposure to gold without physically owning it. They are often used as a hedge during uncertain economic conditions. Many investors include gold ETFs to diversify their portfolios. Another category is international ETFs. These ETFs invest in companies located outside India. They provide global diversification and access to international markets. International ETFs can help reduce dependence on a single country's economy and access to internationals. There are also bond ETFs. Bond ETFs invest in government or corporate bonds. They are generally considered less volatile than stock-based ETFs. Many conservative investors use bond ETFs for stability and regular income. Finally, there are thematic ETFs. Thematic ETFs focus on long-term trends, such as artificial intelligence, electric vehicles, or clean energy.
These ETFs allow investors to participate in emerging opportunities. However, thematic investing may involve higher risk and volatility. Each type of ETF serves a different investment objective. Choosing the right ETF depends on your goals, risk tolerance, and investment horizon. Now that we understand the different types of ETFs, let's compare ETFs and stocks side by side. First, let's talk about diversification.
A single stock depends entirely on one company's performance. An ETF spreads risk across multiple companies. In terms of diversification, ETFs have a clear advantage. Next, let's discuss return potential. A successful stock investment can generate extraordinary returns. Some stocks have multiplied investors' wealth many times over. ETFs generally follow the overall market performance. They may not produce massive returns, but they offer steady growth. In terms of return potential, stocks have the advantage. Now, let's talk about risk. Stock prices can be highly volatile. Stocks have the advantage. A bad earnings report can cause a stock to fall sharply. Market sentiment can also impact stock prices. ETFs usually experience lower volatility because they hold many companies. This makes ETFs less risky than individual stocks. ETFs usually Another important factor is research many companies. Successful stock investing requires studying companies carefully. You need to analyze financial statements and business performance. You should also understand industry trends and competition. This process takes time and effort. ETFs require much less research. Many investors simply choose a broad market ETF and invest regularly. That's why ETFs are considered beginner-friendly. Let's look at the advantages of stocks and invest of stocks. Stocks offer the possibility of very high returns. You gain direct ownership in specific companies. You can select businesses that match your investment ideas. Many stocks also provide dividend income. Sharp price declines often create fear among investors. Many people sell during market corrections and lock in losses. Poor stock selection can significantly hurt portfolio performance. Let's explore the advantages of ETFs. ETFs provide instant diversification, divergent performance. Let's explore the advantage company-specific risk.
They are easy to buy and sell through stock exchanges. Most ETFs have relatively low costs. Invest-lacked. They are suitable for long-term wealth creation. Now let's discuss ETF disadvantages. ETFs usually won't outperform the market by a large margin. Your returns are closely tied to the overall market. You also have less control over individual company selection. So which option is better for beginners? For most beginners, ETFs are the safer starting point. They provide diversification from day one. They reduce the chances of major mistakes. They also allow new investors to learn gradually. Once you gain experience, you can consider adding individual stocks. Many experienced investors use both ETFs and stocks together. They use ETFs for stability, adding individual stocks. Many experienced investors, this approach balances risk and return. Remember, there is no perfect investment for everyone. The best choice depends on your goals, knowledge, and risk tolerance. If you prefer simplicity and lower risk, ETFs, the best choice depends. If you're willing to research companies and accept higher risk, stocks may suit you. Building wealth is more about consistency than finding the perfect investment. Start investing, stay disciplined, and think long-term. Building every investment has certain risks. Learn before investing. If you found this video helpful, please like, share, and subscribe to learn and invest.